This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and today we have two special guests that have been with us many times before, Amanda Han and Matt MacFarland. They're founders of Keystone CPA. Having helped thousands of investors across the U.S. to save on taxes, Matt MacFarland and Amanda Han, as both tax strategists and real estate investors, Amanda and Matt combine their passion for real estate investing with their expertise and knowledge in tax strategies. Their goal is to help investors with strategies designed to supercharge their wealth building using entity structuring, self-directed investing, and income offset opportunities to keep more of what they make. Amanda and Matt's highly rated book, Tax Strategies for a Savvy Real Estate Investor, is amongst Amazon's top seller list. They also are frequent contributors, speakers, and educators to some of the nation's top investment and self-directed IRA companies. Their cutting-edge tax strategies have been featured in prominent publications, including Money Magazine, Realtor.com, and allbusiness.com. Matt and Amanda were speakers at Talks at Google that features influential thinkers and creators. They also have appeared in CNBC's Smart Money Talk radio, as well as BiggerPockets podcasts. Matt and Amanda specialize in bringing top-notch tax saving strategies that are traditionally only available to high net worth clients to everyday investors nationwide. They both have experience working for big CPA firms specializing in real estate and high net worth individual specialty groups. Amanda is a graduate of UNLV and Matt is a graduate of UCLA with a master's degree from USC. Both of them are certified by the California State Board of Accountancy and are members of the prestigious American Institute of Certified Public Accountants. That has grown over the years.
Oh man, sorry about that. Where did you find that bio?
Welcome, you guys. That's funny. I'm just curious, what's the mood of the taxpayer this year as compared to the past?
The mood of the taxpayer, gosh, I don't know. For this past tax season, I think pretty good. We've been in arms of last year about all the pending tax changes that may or may not happen in 2021. And ultimately, none of those proposed changes became reality.
That's right.
Somewhat celebratory.
Okay. Yeah,
when
I was in preparation for this, I was like, okay, all the tax changes for 2021, pretty not a very long list. But okay, I want to ask this. I would think most of your clients own their own home. Would that be accurate?
Yeah, probably a high percentage for sure.
Okay. I wonder if the mood would be different if you were a renter. Because if you have goodies, if you have assets, then you probably enjoyed, the last year and a half extremely well. And if you're on the other side of that, you probably didn't, would be my guess. But I just wondered what your clientele basically, how their mood was. I know Susie Lavis, who does taxes in Riverside, it was interesting. She could take temperature like 2006. Everybody was refining their home twice a year. And it was just a bird's eye view of what was going on. So yeah, most of us are pretty happy that nothing dreadful happened.
But I think it's also probably also depends on whether the person happened to have to pay taxes for the April 15th deadline or not, right? So,
right.
We have a lot of clients that extend their tax returns because they're waiting on K-1s, waiting for different things. But a lot of our clients file their returns and, clients pay their extension taxes due as well. So to some extent, for sure, there's a lot of people that actually had bounce back years after COVID and they, weren't necessarily expecting that for whatever reason. Mm-hmm. So, even though no tax changes happen per se, I think some of them were still kind of, not quite expecting what was coming,
I do think last year, 2021 was year of the refi. Like you said, the homeowners, the investors, The vast majority of our clients had refinances on homes, on rentals, pulled cash out. So that was good. It was also the year of 1031 exchanges too. We probably did more 1031 exchange calculations than most recent previous years as well. Just people moving their assets, into other real estate. So yeah, it's funny. We kind of joke, in the midst of tax time, we're saying, hey, for some of our newer staff, which tax returns can we give to them, right? The easier returns. Mm-hmm. And we almost couldn't find any. There were no easy returns. Mm-hmm. Everybody had refinances, pulling from one property and reinvesting in another. Everyone had 1031 exchange where you sold one California, bought, 5 Florida properties. So no real simple returns for this past year.
What's interesting about what you said, so you talked to them about them refining, let's say their rentals. Did a lot of people in the last couple of years refi their residence? And do you think that will alter their selling habits going forward? If you have a 2 or 3% mortgage in place, what would be the motivation to get a 5 or 6% one going forward? Do you think that'll make people retain their home maybe longer than they thought they would?
Yeah, I think it'll definitely play into the conversation and the decision-making process for sure, right? Now we had clients refining their primaries to, use the money for rental properties. Some clients were refining rentals and using that money to buy rentals or doing improvements on whatever, so it worked both ways. They were just, people were tapping into the equity they'd built up over the last year and a half. So yeah, a lot of money was moving last year for sure.
In your client base, according to California Association of Realtors, about 33% of sellers left the state, which is really a high number in percentage to me. Your client base, did they, at what percentage sold, and did they stick around?
We haven't ran the numbers to see what percentage, but a noticeable percentage, I would say, last year as well as this year. We have a lot of clients who retired, right? That don't need to be in California anymore. So moving out of states. We also have a lot of clients in the tech industry. A lot of them, Northern California, mm-hmm. who no longer needed to be here because their employers didn't require that anymore. So I don't know the actual percentage, but definitely noticeable. And, I would ask them because we're still in California. So I always ask them, like, do you miss it? What do you miss about California? Most people say they don't miss California, which makes me sad, but I guess that's a good thing. They like wherever they've moved to.
They miss the tax bill. That's what they miss.
Yes.
Yeah, they don't miss the tax, right?
Just for fun, I have a presentation tomorrow, so I had to calculate U-Haul cost. And I'm not going to remember it exactly, but this is U-Haul going from San Jose to Austin. So okay. the tech world, okay? So San Jose to Austin is approximately $9,500. The reverse trip is about $1,400.
Wow. So. Sounds about right.
Anyway, I wanted to kind of start off with a worst case scenario tax bill. So I make my money self-employed, let's say, and I make more than the maximum for federal and state numbers. So I'm going to get taxed as much as it's possible. So what is my tax rate? I'm just curious. So if I am self-employed, I pay Social Security up to what amount?
Social Security, you pay up to approximately $140,000.
Okay.
It does change every year a little bit, but
yeah. And the percentage of that is about what?
It's 15.3%.
Okay. But only for a first 140.
Yeah. And then after that, it's only like, 2.9%. So call it 3%.
Now, why do you say that? Is that have to do with Medicare?
Yeah. So after 140, the Medicare taxes, basically unlimited self-employed earnings.
Right. Okay. And then California's top rate is?
If you make, I believe, over $1 million, you're taxed at 13.3%.
Okay. And the federal is what, 30?
Currently, it's 37% for the highest rate.
All right, but that's only for after 500 and some thousand. Is that right?
Yeah, approximately.
Okay. All right. I just wanted to look at those numbers. That's a big number.
Let that sit in.
Let me not earn money in that category, please. which is kind of amazing. We have some tools that allow us to not do that. So that's nice that those still exist. And so some of what we'll talk about is what's maybe next, because there's always been a lot of talk about what to tax next for people that have assets and wealth, but they haven't gotten around to it yet. So let me just ask a couple questions about the state of California, then we'll leave that. Social Security, I've not taken a Social Security yet, but I have to in November because I'm 70. Is that taxed? I'm not in California, but if I was that going to be taxed by the state of California?
No, the state of California doesn't tax that. So
that's cool.
Yeah, the IRS does obviously, but the state of California does not.
Okay, I didn't know that. That's good. Is the capital gain tax in California different than regular earnings, or is it the same?
Same for California. California doesn't have any special capital gains rates. So you're just going to pay whatever your marginal California tax bracket is on that.
Okay, so no benefit.
Yeah.
Okay. All right. So what are the changes that actually occurred in 2021? This is going to be a very boring small list.
Yeah, I mean, it actually is. It's trying to think back, we were so inundated with the CARES Act and COVID and everything that there were so many changes happening in that 2020, right? That 2021 had a few things, but nothing major, because it was always the threat of what's coming. What are they going to change? And they just didn't get around to changing it for 2021. I know that the CARES Act, or it was the American Rescue Plan, one of those, they made a lot of student loan forgiveness to be tax free. So that was kind of new for 2021. We saw that affect some of our taxpayers. Trying to think of their big picture stuff that
there virtually isn't any.
Yeah.
I mean, that's the only one that comes to mind off the top of my head. But
when you have a retirement account, I think it's 72, you're supposed to start withdrawing, and then they kind of pause that because of the downturn of the stock market and everything, people having to force sell assets that were sort of way below where they were. Did that continue, or has that been reenacted where you have to take the income?
Yeah, that was brought back into play. So it's back, reenacted. So you do have to start taking your required minimum distributions. They did change that age, as you noted, from 70.5 to 72. I believe, in the past year, there's been some talk about extending that to 75, but I don't know if, whether or not that gets added back or not, who knows, obviously, but currently it's 72 years old and you do have to start taking RMDs again.
What's interesting about that, I don't know if you've ever taken a look at the chart of how that progresses, but if you think about life expectancy, maybe we're at 82 or something like that. Mm-hmm. So you think if you start at 72, you'd be taking 10% of whatever it is.
Yeah,
and
right.
It's nothing close to that.
No, I think it works out like it pushes you into your 90s for sure, right? If I
it's 104.
Okay, is that what it is?
Yeah. Last time I checked, I was looking at it because I'm thinking, again, I'm 70, so I think, okay, well, I've got to do some of this. And then I saw the amount I had to take, which was basically going to be the interest on what I get. So it's not really a withdrawal of anything. It's just that was funny. And then it kind of progresses. But it went past 100, so I just thought, okay, well, that's.
Well, I don't know. I just saw a headline recently that the world's oldest person at 119 just passed away. So maybe the IRS knows more than you do. I don't know.
If he was on Social Security, man, he made out.
Like a lifetime, right?
Yeah, twice. Yeah, literally almost twice the age. All right, so let's talk about some of the things that are being contemplated. Are they going to get resurrected, or is this an election year? We'll probably have nothing happen again. So what's on the list, and what do you think has a chance to change the game?
I like how you use the word resurrected, because it definitely feels like that, when the original proposals that came out in 2021, we thought they were sort of gone for good, because they were eventually removed. But now with the 2023 budget, a lot of the previous proposals look to be back again in the original format. So, increasing the top income tax bracket to 39.6%. And that's for single taxpayers making $400,000 or more. And we still have that marriage penalty, which for married people, the highest bracket kicks in at $450,000. Instead of, like a number like 800,000 or something like that. So
Right.
that's almost exactly the same as what was in the previous proposal. Capital gains, I think that was also, same as the previous proposal. Capital gains qualified dividends for those people making over $1 million of taxable income, to effectively tax that at 37%. Instead of the 20%.
Well, and probably actually 39.6 if they go out and they
Yeah.
change the rate, right? So
Yeah.
So basically doing away with the preferential capital gains rate for the amount in excess of $1 million, but still, it's changing.
That could
the
be
game.
one house in California.
Yeah, I mean, it's changing the game, right? It's going to change the number significantly.
Well, what do you think the reaction of your client would be? You just say, well, we're not selling. Would that?
Well,
be
that's the thing.
reaction?
I think it's a give and take, right? There's one avenue where it's like, hey, I'm just going to hold it longer because the exit cost is going to be a lot more, right?
Right.
Or it's going to, people who are making over $1 million, it might encourage more short-term trading because the incentive to hold things longer than a year is going to be gone, right?
Right.
So I think it just depends on, what the situation calls for.
Yeah.
Well-
And then people might accelerate some sales into this year too, right? If it's looking like this change will be in effect January 1st, 2023, you might see a lot more movement before the end of the year, just for people to lock in that 20%.
That is an interesting point, actually, is because some of this stuff, everything we're hearing, some of it is proposed to take place January 1st, 2023, assuming it, passes between now and then. And some of it actually may be effective as soon as the law is passed. So like we've heard the capital gains might be January 1st, but we've also heard that it might be effective. That might be the one that's, once the law is passed, signed by the president, it's effective that same day. So, how much time do you have?
The word retroactive hasn't come up, has it?
Not so much, but
God.
Yeah, but also, before there was talks of 1031 exchange, right, being eliminated, repealed or limited. And so we all celebrated when that seemed to have gone away. And now that's also resurrected as part of the budget proposal to cap that per year per taxpayer to $500,000. So, you can basically...
Yeah, 500 for single, right? And
a million for married. Yeah. So if you sold a building, you had, $700,000 worth of gain, you could still defer 500,000 via a 1031 exchange, but then you would have to pay taxes on the excess, right? The remainder 200,000, it would be taxable. So I think that's something that could really impact investors' decisions on when to sell. When to sell, maybe 1031 before the end of the year, before there's limits, or maybe just not doing it. If you have a large gain that, you can't sell, part of a property, right? Part of a building, then they might be more, open to keeping the property and just doing refinances to pull out the equity.
Okay. What about the going after the existing wealth? A wealth tax. Is that something that's?
Yeah, I think that's probably one of his biggest ticket items, is he's looking to implement this kind of minimum tax on wealthy people. You can call it a net worth tax, you can call it just this minimum tax, but basically people that it kicks in once somebody has a net worth of $100 million or more. So maybe that doesn't apply to obviously a lot of people, but it would apply to enough people that they're contemplating passing a law, obviously.
What I think was so interesting is they called it a billionaire's tax, but like Matt said, it's only, it's not on billionaires, it's on people with 100 million or more in net worth. And I think that's the one that's already gotten pushback from the political parties on, not really in favor of something like that. Also, the CPAs, the profession, has come out and indicated this would just be something that's going to be difficult to enforce, right? Having to essentially get valuations on net worth, because not everything is, readily available for valuation, right? So that would be a difficult one that, hopefully won't get too much traction in terms of passing.
Yeah, that's a crazy thought. Appraising everybody's assets every year. Mm-hmm.
Yeah.
Well, and part of it would include, obviously it's on your net worth. So that would include taxing people on unrealized gains, right? And
that's a whole nother topic in a way.
Well, right. And the way they wrote it was like, they're going to somehow keep track, the tax you pay in this, there's going to be a portion related to certain assets, I guess. And then the portion related to your unrealized gains is going to be like a prepayment towards taxes you would otherwise pay when you actually have a realization event later on when you sell the asset. I mean, just think of the nightmare of complexity of keeping track of all this stuff.
Because the next year, let's say a stock market, you could have a good year last year, and you could have a terrible year this year.
Yeah.
So what happens then? Do you get a check back from the IRS as a credit? Jeez. I'm glad you're in the tax business and I'm not. Wow.
Bruce, can I ask a quick question?
Yeah.
So, a lot of these things didn't pass, but one of the things that had people up in arms also was the IRS hiring tons of agents and the thought that there was going to be increased audits and things like that. How did that come to fruition?
Oh.
Well, they're outside your door right now, Joey.
So yeah, the proposal was to allocate a lot more funding to the IRS.
Yeah.
To be fair, they didn't say it was all for additional audits. Some of it was for audits. The others were for IT advancement and taxpayer services, so that when you call, someone will actually pick up the phone and answer your questions. So I know that the IRS has already increased headcount, and they're aggressively doing so even as we speak. Now, how many of those people will actually, again, be for taxpayer services versus audit? We don't really know yet. But yeah, I don't think that's a stretch. I think that is still their plan, because historically speaking, every dollar they invest into IRS enforcement typically results in $4 to $5 of tax revenue at the IRS level. So, it's a good use of funding from their end. And of course, whenever someone gets a tax bill from an IRS audit, usually the states will get a notification as well. So if you owe IRS money because you had a wrong transaction or reported something wrong, it's almost automatic that California, as an example, will send you a bill shortly thereafter too.
So they snitch on you
for their share. Yeah, I think they call it. I don't think they call it snitch. It's more just.
You're watching too many mafia movies, Joe.
Is it a commission? Is it a commission arrangement?
I don't think they'll get paid. It's just some. Sharing agreement.
No point to that. Okay.
Yeah, but it is help government, right? Because when the states get additional funding from taxpayers, that's less money that the IRS or the Treasury has to allocate to the states for funding. So yeah, helps both of them.
Okay, that's going to do it for this week's episode of the Norris Group Real Estate Radio Show and Podcast. Please be sure to tune in next week as we are joined once again by Keystone CPA founders Amanda Han and Matt MacFarland. See you then.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.